It's the beginning of another earnings season and the kickoff begins with TCS. Numbers come out post-market hours about 4:15. And the stock, while it's been an underperformer like the industry, year-to-date down 20%, this week TCS has seen an up move of 4.5%, while the Nifty IT index is up 3.8% this week, the last 3 days. Now, the question is the pace of the earnings downgrades perhaps come to an end? Now, in the case of TCS, for the last 2 quarters, the company reported a decline in their constant currency revenue growth because that large BSNL revenue was tapering off. But this quarter, the expectation is that revenues will be flat. So it's still going to be a muted quarter. It's not that there is growth, but at least it's not a decline. So constant currency revenue growth, according to our poll, should be up about 0.2%. Secondly, on the margin front, the rupee depreciation of about 2.5% seen this quarter is acting as a big tailwind. It's a positive. And plus, for TCS, in terms of a wage hike, typically they give it 1st of April, effective 1st April. But this time they had deferred it due to uncertain environment. So now their wage hike is effective 1st September. So the wage hike impact on margins will be split across 2 quarters. And in the current quarter, there will be only a 1-month impact. Plus, you've got that INR depreciation, so margins could inch up. What will the street watch in terms of, the big things? One is this, remember they let go of 12,000 people? That's quite rare when it comes to the Tata Group and TCS in particular. It's never happened. So we'll quiz the management on them. They'll be joining us tomorrow. Other than that, the H-1B visa hike, does that increase the on-site cost for the company? What are they planning to do? De-risk it in some way? Then generative AI from pilots, are they becoming big projects? Are they able to monetize it? And is there AI-related pricing deflation? That is the big fear because technology continues to get cheaper and cheaper. So these are some things that the street will watch. And of course, the big picture is discretionary spending coming back. BFSI has been doing well. Does the momentum continue there? Does it spread to the other sectors? But I think the key takeaway is that stock has been a big underperformer. Year-to-date down close to about 20-25%. This week, you're seeing some price action, which seems to suggest some stability, pricing moving up. Growth is missing so far in Q2, but hopefully it doesn't decline. Sandip Agarwal, the fund manager at Sowilo Investment Managers, is now joining in. Sandip, first, give us your opening thoughts. What should we expect from TCS?
Hi, good morning, and thanks for having me on the show. So, we are monitoring the sector, and since I run PMS, I don't make estimates now, but I can tell you that the way we are seeing the estimates from the analyst community and the way we are seeing commentaries of different management, my view is that the number which you are projecting, flattish quarter on quarter and a decline of 3% year-over-year revenue growth is what the numbers will be broadly there. And yes, margins may go up a little bit because of rupee depreciation and also wage hikes being postponed. But remember, margin only till EBIT level reflects that benefit of rupee. But on the other income, there could be a negative impact because generally these companies hedge very, means almost 100% hedge they take for the near 6 months revenue, net receivables. So I think, you may not see benefit of rupee at the PAT level, but definitely you will see benefit of rupee depreciation at the EBIT level. So we are also on the same page that, earnings will be muted, growth will be muted. Obviously, the sector has massively underperformed. So people may want to look fresh at this sector and buy some of those names and keep them as defensive or quasi-cash. That is a separate call. But I believe the right way to look at the sector is the PEG ratio, and PEG ratios are still insanely high for large part of the sector.
Sandip, Rima and I'll get some time with the TCS management later today. What should we ask them?
You should ask them will the growth be double digit in next 5 years, any of the year. I don't think it is going to happen.
Okay. Anything on the entire things around AI has been a big talking point. I mean, generally there is understanding and that maybe where India plays in this entire AI thing is not the hardware, etc., but it's essentially application on the application layer, and that's where IT services come up as well.
So, I have always told this many times in last 1 year, 5-6 times at least, that, we are trying to find something from the IT services firm. They are doing their business quite well, and, the maturity of this industry is very high now. So expecting more than mid-single digit to high single digit growth on a consistent basis is little too much. It will not happen. Same has not happened with Accenture in last 5 years also. They have been growing, including in organic, in mid-single digits. So we should not expect. It is a mature industry. the application also, you have to remember that there is a 30 to 40% decline in efforts because of AI. So I don't think any services company, whether it is Accenture or any Indian company or any European company, they can grow at the same pace at which they were growing during COVID times or before that. I have a very clear view, and we should try to find big tech in our Indian universe. I am very confident we will see 8, 10, 15 big techs coming from India, but not in the same space. They would be in consumer tech. That is our strong call.
Tata Elxsi also reports, now ER&D was one space where we were seeing growth. Now growth is moderated, and then came KPIT when they met, I think, certain brokerages. They're talking about negative revenue growth in Q2. And analysts are saying, well, it's going to be a washout year. I mean, on ER&D, as you said, for maybe IT services, we don't see a double-digit revenue growth for the next 5 years, in any of the years, forget, as an average. For ER&D, what's the PEG ratio looking like? And do we still have a recency bias when it comes to ER&D? Because they've done so well over the last 5 years, you kind of just expect that it's going to go on.
So, ER&D will grow at 2.5 times of the IT services growth. But the problem is IT services growth itself will be like 3-4%. So even if ER&D grows at 8-9%, Indian IT companies do phenomenally well in the ER&D space. Then also we can't expect more than 14-15% growth. And the multiple at which they are trading are close to 40-50 times. So basically we are talking about 3-4 PEG ratio for a 12 to 15% growth, with all the risk of some challenges happening in the US, some risk here and there. So I don't think, they are even fairly priced. ER&D will definitely grow much faster than IT services, but so are the multiples also much more expensive. So I don't know whether we can make money in the mid-size companies and large-size company. It looks very difficult.
Any thoughts on the global tech plays? You look at that very, very closely. What is your view? There is one camp which believes that we are entering frothy, the frothy space, and maybe tech stocks globally will need to take a pause.
No, so, I have seen in last 20-25 years, whenever this barter system of buying stake and all these things starts, then, that is close to peak. And I am also in the camp which believes that, there is too much of noise on AI. AI is definitely disruptive and doing a lot of good work is happening. Efficiencies are coming, but the amount of money which people are committing, that money will not be required. So basically a bubble is there in terms of what you are investing. Although, we believe that, some of the anomalies, like if a company is trading at $4.5 trillion market cap, I think it is grossly wrong, because finally it will become a commodity at some point of time, and the challenger who is there, he will do phenomenally well. So I believe that, the main player may come down substantially and the challenger may go up substantially. And that is our call for last 4-5 months. And we are seeing substantial outperformance there as well.
Okay, Sandip, we leave the conversation here for now. Thank you very much for joining in.